Good morning, professionals you trust. My name is Leslie McFadden, and today I have the honor of introducing our featured presenter for the week, Tina Mitchell with Highlands Mortgage. Tina answered a few questions for us so that we can get to know her better. The first question is, what is your biggest aha moment in your business? Her answer, business is not just getting connected with others. It is also connecting them to each other. I do this through my events platform. Where do you want to retire? Her answer is awesome. Her answer is everywhere. When I would like to retire is the hard question to answer. I really love what I do, but to be honest, if I was done building wealth, I would retire. I would continue my community platform with coaching and keynote speaking, but I could do that from anywhere. I can see myself working until I'm at least 60. We will have to see if I am ready to slow down by then. The next question, what would you do if you knew you could not fail? And her answer is fly like a bird. I can see that. And then her last question, what is your dream job? This is an obvious answer. I am currently doing it, and I still have time to do everything else I want to do. That is why I love my career. Everyone, please welcome Tina Mitchell.
Thank you for the introduction, Leslie. I appreciate that. And I'm not going to provide or have a slide deck today. I'm just going to have a conversation with you. I wanted to share the real truth about the real estate market and compare it to what the media is saying. Media sells fear. The media is creating real estate land of confusion. There was a story on affordability that captured the media headlines. Their report showed that monthly payments increased 28% from last year, which sounds concerning at first glance, but you must take everything into account, including incomes. Comparing the payments from last year to year to date for this year, that statement would be correct. But when you take income into consideration, that gives you a full picture and the real affordability. Incomes have increased 6% since last year, but that's all wealth growth. Private sector wages have gone up by almost 10%, which is likely a better representation of home buyers. Let's choose 6% in factoring in the increase in monthly payment. The real change in payment ratio is only 3%. The impact to consumers is much less than the media headlines would lead you to believe. Now, I have also heard the media say that household formations are lagging and that we could be in an oversupply situation for inventory. Let me go ahead and break it down. There are 1.4 million household formations in March annualized pace, which is historically a pretty strong level above the average. At the same time, looking at today's housing starts report, there were 1.7 million total starts, which includes single family and multifamily, meaning places to live, buy, or rent. But each year, about 100,000 homes are destroyed due to aging and replacement. So that means that on a net, we are seeing around 1.6 million home creation. Now, subtracting out the 1.4 million home formations, that is approximately 200,000 units that are going towards the undersupply that we are seeing in housing. Don't let the media mislead you. It's surprising to see what some of the media platforms are putting out there on the market and how wrong they actually are. Watching for the MBA numbers to come out on mortgage applications, I could not believe what came out of the mouths of Diana Olick and Becky Quick, as they went through the numbers and tried to terrify first-time home buyers by telling them that their rate for a first-time home buyer that they would pay would be 7%. No joke. This is what they said. Why they would say this and where they're getting their information, I have no idea. I just want you to know where the information that they're stating is incorrect. It's hard to imagine what they're putting out there in their statements, but I would like to set the record straight. For first-time home buyers, there's no special rate that you have to pay. There's no penalty for being a first-time home buyer. And then they came out and they were teasing all morning as we had a long wait to see what they were going to say next. And then they said dramatic downward revision in mortgage originations for 2022 from the MBA. The report showed that they only went from 2.61 trillion to 2.58 trillion. Not exactly a dramatic downturn. There was also an article by Diana Olick on CNBC citing that according to Redfin, 12% of homes for sale had a price drop last month. Now, insinuating that we are heading towards a bubble. For comparison, this figure was 9% a year ago, and we are starting to see some of the froth come off the markets, of course, but even last year, when they had one of the hottest housing markets on record, 9% of the listings dropped their prices. So we're seeing a slight increase from that level. Now, also within this article was mentioned that listings are up 8% from a year ago, which will lead to more supply and decline in home values. Well, it's typical increases that we see every single year going into this home buying season. In fact, last year, inventory rose 10% between April and May, and every year prior, we saw a big increase during this period of time. Inventory levels are still near record low. There is still and will continue to be an inventory issue. There is no solution to the shortage in inventory. To get us to a balanced market, we need to build about 4 million homes in a year, and builders have never built more than 2 million homes in a year. Inventory levels have been depressed in the media is saying that we're going to see a housing bubble like we did in 2007. Oh my gosh, there were 3.81 million homes for sale back then, which was an oversupply while demand couldn't absorb it. Now, today's inventory has been getting tighter and tighter, which is now only 950,000 homes for sale in the entire country. At the same time, 14 million more households, and banks are only lending on good loans. With all of the negative talk in the media, Google search results on a housing bubble are on the rise. Of course, rates have moved up, and that has had an impact on with the affordability in a small way. But with the demand caused in the housing bubble, or rather will we see a slowdown in appreciation? I believe that instead of seeing a 20% appreciation like we did in 2021, we're going to see a more modest to mid-high appreciation, which is still extremely meaningful on wealth creation. Let's just say we saw a 5% appreciation, and I think that this is a very low conservative percentage to use. If you were looking at a house for $500,000, you would need to save $25,000 in a year just to keep up with appreciation. Most people cannot save that much money in 1 year. This doesn't even factor in the most likely higher interest rates. If rates only went up to 6% to 20% with a 20% down payment, your monthly payment would increase $250 a month, and that would drop your buying potential by $55,000. That means instead of being able to purchase a home for $500,000 with the same payment, you could only purchase a home for $445,000. I believe that now could be the best time to buy. Interest rates have increased, but with every challenge, there's a hidden opportunity. And I see the increase in interest rates as this hidden opportunity. The reason is temporary slowdown in the buyer frenzy. Some buyers have backed on the market because of the interest rate shock, not because they can't afford to buy, but because of the shock factor. The buyer traffic has slowed down a bit, so the crazy multiple offers have eased up a bit. This is temporary because when the new rates become the new norm, the shock value will wear off and buyers will start flooding the market again. This is a temporary opportunity and will be a missed opportunity for buyers that don't take action right now. Buy now while buyer traffic is down a little. Now, do I think that the interest rates are going to go down? Yes, I do. The reason is a guaranteed recession is coming. If we look at the history of the government spending, 40% of the money printed in our history has been in the last 24 months. That means money that flowed into interest rates, the stock market, and everything else. We've been running on stimulus money. The recession is coming and it's going to be a big one. But a recession is not the same as a depression, which can last for years. Once a recession passes, economic expansion will begin again. A recession is a period of temporary economic decline. Now, history of a recession, and mortgage interest rates decline, and the people that own real estate favor well. Why mortgage interest rates go down? It's because they are based on the Fannie Mae 30-year bond and how it's trading. When the bond market drops in trading price, mortgage rates go up. But when the bond market gains in trading price, mortgage rates go down. During a recession, there's a lot of investors that are putting their money in bonds as it's a safer place for them for their money to sit. The return is lower, but the risk is lower. The volatility of the stock market during a recession is not worth the risk for some investors. What about the Fed's increasing the Fed's fund rate? Why would mortgage rates go down? Yes, the Fed will be continuing to increase rates, but this is on the Fed fund rate, not mortgage rates. The US mortgage rates are not set or established by the Federal Reserve. When the Fed increases rates, they're only directly tied, the only rates that are directly tied to what the Fed is doing is short-term rates like the prime rate and credit cards. Mortgage rates are directly tied again to the Fannie Mae 30-year bond. When the Fed makes a move, all markets, of course, react, but they react differently depending on the impact to consumer confidence. With the Fed's decision, it causes a lack of consumer confidence, then that favors well for the bond market, which means mortgage rates go down. So why not wait until interest rates go down? The reason why is the appreciation. As you wait, you're missing out on appreciation. If you locked in an interest rate today, and they went down, you could just refinance, but you've locked in that appreciate gain. And if you want to own real estate during a recession, the reason why is because same as inflation. Real estate is one of the only investments that you have to hedge against inflation and recession. Inflation, simply put, is the increase in cost for goods and services. What cost you today $100 yesterday, what cost you yesterday $100 may cost you $105 today. The value of the dollar is worth less, so it makes more dollars to purchase those same goods and services. Homeowners benefit from inflation because the money that you pay back, it's a fixed rate mortgage and it's worth less today than it was yesterday, but it's fixed. Everything else that you have to buy, it's costing you more, except for your mortgage because it's fixed. The higher the inflation, the rate, the sooner your home value doubles based on the rule of 72. Now, home prices rise with inflation because as the value of the dollar is worth less due to the higher inflation, it will cost you more dollars to purchase that same property. Real estate traditionally has worked very well as an inflation hedge. We are not heading towards a bubble. Call to action, act now. Tina Mitchell, making a difference in families, one mortgage at a time.